Hello, everybody, and welcome to Cafe Mutual YouTube channel. First of all, happy Independence Day to all of you. So, in this Independence Day, we have with us Manish Gunwani, CIO, Equity, Nippon India Mutual Fund. Manish has been with the fund management industry for the last 20 years, and he has excellent track record of outperformance. So, welcome to YouTube Cafe Mutual's YouTube channel, Manish.
Hi, thanks for having me. I'm wishing everyone a happy Independence Day.
So, Manish, congratulations on launching Nippon India Multi-Asset Fund. And we would like to firstly understand that what is the rationale for launching Nippon India Multi-Asset Fund in this current market condition?
Actually, one of the big points is this current market conditions phrase itself, we don't think is relevant for this product because this is a product which has a very good mix of asset classes, which we think people should hold for the very long term. And in this environment where a lot of asset classes seem to have gone up a lot in last 3-4 months especially, um, I think it is good to be diversified rather than concentrated in one asset class, because if you see equities since March has gone up, gold has gone up, foreign equities has gone up. Now, of course, there are various points of the cycles where these different asset classes are. So Indian equities, while they've done well since March, if you compare since 2018 or even last 5 years, we have not done anything. So every asset is moving through a different cycle, but what we are telling investors is for the long term, these asset classes have to be having a certain weight in your portfolio, and that weight we have captured the structural weight, if you can call it. The long-term weight each asset class should have in your portfolio, that we have captured in this fund, and you keep this fund as a core, and whatever fully diversified fund, thematic fund, sectoral fund, you add on top of this. See, no asset class should go to zero in your portfolio at any point, because you can't change 100% of your portfolio based on tactical calls. So this is a kind of foundation for every portfolio on which other funds can be added.
Manish, how correlated is domestic equity funds and international equity? I mean, exposure to domestic equities and international equities.
That is an interesting point, because when we talk of domestic equity being 50% in this fund and foreign equity 20%, people say, oh, it might be very risky because 70% is equity. But if you see the data, the correlation is less than 0.2%. That is, if you 1% means 100% assets will move together, and 0 means assets move differently, the correlation is actually very low, around 0.2%. So that way, foreign equities definitely give a diversification from Indian equities. Also, what is important to remember is uh, typically when India is going through a problematic phase, the rupee depreciates and Indian equities fall. But rupee depreciation actually helps the value of foreign equities, because for us the rupee value matters, but these equities are quoted in dollars. So that way, even from a currency perspective, foreign equity gives you a good diversification.
Okay. So, Manish, according to various studies, more than 90% of the portfolio return in multi-cap asset funds are based on asset allocation decisions, right? So, what is your asset allocation to maximize return in this fund?
See, as I said, we are keeping 4 different asset classes, and their weight in the fund is what we think is based on the long-term return of each of these asset classes. So if you see 50% is domestic equities, because domestic equities can be volatile, can go through 2-3 years of underperformance as we are seeing over last 3 years. But long term, we believe that India will be a reasonably fast growing economy, and Indian equities will mirror the growth of India. So that is why we've kept it maximum at 50%. But after that, we are not changing the weight too much. But what we will do is we will do quarterly rebalancing to make sure that we follow a kind of valuation and mean reversion kind of thing. That let's say if Indian equities do well and weight goes up from 50 to 53% in a quarter, then we will sell that 3% and get it back to 50%. So in a way, we are selling what has done well, and we will buy something which has not done well. That allocation will help us keep valuation discipline, and typically most of these big asset classes over long time will revert to their mean return. So by selling something which has performed and buying something which has not performed, we believe we will add value to the asset mix.
Okay, so how often will you make rebalancing?
Every quarter.
Okay, every quarter. So Manish, at a time when most asset class have been relatively volatile, so why does it make sense to invest in multi-asset funds, according to you?
See, what happens is people have preferences, or we can call it a bias for certain assets. And the problem we are seeing in terms of asset allocation is that something like foreign equities or gold, if you see the AUM of a mutual fund in these categories, it is very trivial. Now, why is it trivial? Because these are not probably asset classes which are easy to understand, easy to access. But at the same time, people's net worth should have certain allocation to these asset classes. For example, last 10 years, foreign equities has outperformed domestic equities, and 10 years is a fairly long period of time. So in a way, Indian households have lost an opportunity, you can say it that, because they did not 10 years back invest in foreign equities. So what we are saying is that all these four different asset classes should have a weight in this portfolio. And overall, what will happen then is the total return will be much more stable than any single asset class with lesser volatility. See, typically in your net worth, the core portfolio has to be low volatile, steady products, right? You can't have very high volatile products as 80% of your net worth. So this fits that bill key as a core part of your asset allocation. This fund, as I said, can be the foundation because it will provide steady return with low volatility.
So which categories of investors should look at this fund?
We believe for all investors, because anything which provides steady return with less risk is good for all investors. As I said, it is not a niche product which is going to be very volatile and but promises very high returns. This is going to be a product which has very good diversification benefits. It has better diversification than a lot of balanced funds because there are more assets. It has exposure to foreign assets, which gives you currency diversification as well. So that way, we believe it can fit as a core choice for a wide variety of investors.
So Manish, one interesting question. So overall, multi-asset funds are like Khichadi, good for health but not so sought after. So in such a scenario, how do you plan to serve it like biryani, that is giving confidence to investors that the fund is good for both in terms of health as well as wealth?
So we believe that we have to do what is in the benefit of investors, and you will agree that for regular eating, khichdi is better than biryani. So the point is, we can't serve biryani every day. So what we're saying is, as I said, have a core uh, allocation to this product, which will be your khichdi and keep you healthy. And periodically, we will serve biryani as well. But this time, we're serving khichdi only.
Okay, Manish. So, Manish, you must have back tested the fund. So can you please take us through 3 and 5 year performance of the fund?
So clearly, we have done a lot of back testing. So one is on a 10-year basis, what we've seen is that this fund very consistently gives the return of 9-10% in that range. And you talked about 3 years. In fact, we did 3-year rolling return. And not only is the return good, But if you see the number of instances in which you get a negative return, it is far, far lower than any of the individual asset classes, or I would say any other asset class which is not in these four classes as well. So that definitely is what gave us confidence to launch this fund, that the data looks really good.
So Manish, a lot of financial advisors use reasonable return to do their financial planning and draft financial plan for their customers. So what kind of reasonable return they can expect from multi-asset fund?
So we can't give projections for future, but as I said, a 3, 5, 10-year rolling data seems to suggest that this fund, if it had existed, would have delivered 9-10% kind of return. Obviously, future will depend on how each of these asset classes perform, where interest rates go, where global growth goes, and all that. But definitely, that is what the historical data is telling us.
Okay. So Manish, apart from diversification, so how do we plan to mitigate risk in this fund?
So what we've done is within each asset class, we have a lot of risk management guidelines in place. So if you look at domestic equities, we have put guidelines in terms of what will be our active share being less than 50%. Active share is how far are we from the benchmark. So what we are saying is we will not be very far from the benchmark vis-a-vis a fully diversified fund. Similarly, for the domestic equities, we've said there will be limits on sector deviation, limits on the quality of stocks, the lower high volatile stocks we will not have beyond a point. So those kind of guidelines are there. If you look at commodities, what we are saying is within that 15% of commodities, minimum 10% will be gold, because gold gives you the highest diversification versus Indian equities. So for example, oil is not giving you that kind of diversification, right? So within each asset class, again on debt, we have said that we will have 85% high quality paper. On the foreign equities, we are following a very big global benchmark. So we're not taking bottom up calls on stocks. We're just following a big benchmark. So at each of these asset classes, we have put guidelines to ensure that there is good risk management in place.
And apart from gold, what kind of commodity you are looking at?
So what we are doing is we have 15% commodities where we are saying minimum 10% is gold. So rest 5 could be gold again, could be oil, could be metals. So any kind of commodity for the next 5%.
Okay. So Manish, have you considered taking exposure to real estate through REITs and InvITs?
No, we're not putting that right now because we believe that, with these 4 asset classes, in a way, these are 5 if you count gold and other commodities separately, because there is not too much correlation between gold and oil, as I said. So effectively, we have already 4 to 5 different asset classes. So we believe that, the khichdi will get even more khichdi if we add too many things. And see, REITs don't give us too much diversification away from the debt part of 15%. So if it's not giving us too much benefit, we did not feel the need to add REITs at this point in time.
So Manish, how Nippon India multi-asset fund is different from other funds in the market?
So a lot of asset allocation funds are there. In a way, the most simplest asset allocation fund is the balanced fund where you have static equity and debt. Right from that to multi-allocation products are there. But we believe that this mix of 4 different asset classes, first of all, is pretty unique in the market at this point of time. Second is what we have seen is that even in multi-allocation products, multi-asset allocation products, a lot of the other products have very high component of domestic equities. Probably because of the tax structure. Now, what we are saying is, yes, tax is important, but more important is the diversification in a multi-asset fund. So if we have more than 65% in domestic equities, it doesn't give you any great diversification, which is why we have capped domestic equities at 50%. So that is another way we are different from a lot of other products.
So, Manish, why should distributors recommend this fund to their clients?
So as I said, most investors, whether it is domestic or even global today, see, we are living in a fairly low inflation, low growth kind of environment. And there is a big need for people to have steady return with low volatility. Um, a lot of people say that we can do this on our own by mixing these funds. But what we have found, as we mentioned, that if you look at the AUM of foreign equity fund or gold funds, clearly investors have not taken part in those asset classes. Second is for distributors and investors to do it on their own. The rebalancing is cumbersome, the taxation impacts are cumbersome. So we believe at one shot, this is a very, very effective way of getting exposure to four of the biggest asset classes. And as I said, it can create the foundation for every investor on which rest of the tactical calls can be built.
Okay. So, Manish, one last question. So, what should be the investment horizon to invest in a multi-asset fund?
See, multi-asset funds themselves, like our fund, have a lot of diversification in the construct. So to that extent, these are not funds which should be used for tactical calls to my mind. So the allocation to these funds has to be really long term. So this is, again, just to repeat, something like the foundation of the house. You don't change the foundation of the house, you change the interiors, etc. So this is not a fund where you go for 3 months or 6 months. And that is one of the reasons, in fact, why we felt that even if we have debt taxation, it is important to give diversification benefit so that people come with a long-term view to this product. So we believe that people should look at this product as a 5-10 year product within their portfolio.
Okay. And what kind of allocation should I give to this fund?
So again, going back to the point of it being a core part of the portfolio, this is again, I feel not a product where you should allocate 1-2%. It's one of those products which has to be 10-20% of the portfolio. But having said that, I think the multi-asset products themselves are a new concept relative to, let's say, diversified equity funds. So I'm sure it will take time for the market, time for investors and distributors to get comfortable. So I realize the practical issues, but theoretically, if you ask me, this should be a very big part of the asset allocation for a lot of investors.
Okay. And what will work best? Staggered manner or lump sum?
I would think this is a product which suits the lump sum mode because there are a lot of diversification within the product itself. So you don't need to time entry into these products too much. So I believe that lump sum is better.
Okay. And Manish, can you take us through the fund management process on the equity part? What would be the philosophy?
So as I said, we will manage the equity part, domestic equities part actively, but we are also conscious that this is part of a multi-asset fund. So what we are saying is that we will not dilute the benchmark returns too much, which is why the active share or how much we are close to the benchmark relative to general diversified fund, we are closer in this product. So active share will be less than 50%. The sector deviations will be less. The large cap part will be 50 to 70%. Rest will be mid cap. Practically, we don't intend to have small caps virtually in this product because again it's part of a multi-asset allocation mix, so we don't think that small caps fit in with that mandate. And that will be the way domestic equities are managed. Foreign equities, as I said, we are mimicking a global index, but we are compressing that a lot. See, the global index, because it takes care of all the geographies of the world, all the big stocks, has more than 1,000 stocks. We are compressing that into 25 stocks.
Thank you so much, Manish, for your valuable time and input, and all the best for the fund.
Thanks a lot and look forward to your support.
Thank you, Manish.